Do you ever wonder what an IPO, or an initial public offering, is? Why is it such a big deal in the world of business and finance? Well, an IPO is when a private company opens up its shares to the public for the first time. This crucial step allows a company to raise equity capital from public investors. It's a pivotal moment for private investors to maximize their gains, as it typically includes a share premium. At the same time, it gives public investors a chance to jump in on the offering. Now, before an IPO, a company is deemed private. Its shareholders are a limited group, usually early investors like the founders, family, friends, and professional investors such as venture capitalists or angel investors. When a company decides to go public, it's a significant milestone. It grants the company access to a vast amount of capital, giving it a greater capacity to grow and expand. The added transparency and credibility from being listed on a stock exchange can also aid in securing better terms for borrowed funds. A company will typically start considering an IPO when it reaches a stage of growth where it's mature enough to handle the regulations imposed by the Securities and Exchange Commission, along with the benefits and responsibilities to public shareholders. This stage often occurs when a company reaches a private valuation of approximately $1 billion, also known as unicorn status. However, companies with various valuations showing strong fundamentals and proven profitability potential can also qualify for an IPO, depending on market competition and their ability to meet listing requirements. The pricing of IPO shares is determined through underwriting due diligence. When a company goes public, the previous private share ownership converts to public ownership, and the existing private shareholders' shares become worth the public trading price. The underwriting process may also include special provisions for the transition from private to public share ownership. The public market presents a vast opportunity for millions of investors to purchase shares in the company and contribute to a company's shareholders' equity. This group consists of any individual or institutional investor who wants to invest in the company. In essence, the number of shares a company sells and the price at which the shares sell are the driving factors for the company's new shareholders' equity value. Even though shareholders' equity represents shares owned by investors, when a company is both private and public, an IPO significantly increases the shareholders' equity with cash from the primary issuance. So, an IPO is more than just a financial event. It's a significant milestone in a company's journey, marking its transition from a private entity with a limited number of shareholders to a public company open to investors worldwide. It's the process that enables a company to grow, expand, and potentially become a major player in its industry. So next time you hear about a company going public, you'll know exactly what's happening and why it's such a big deal.